Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome, my dear people. Welcome, my dear friends. I am Abdulsad. Today I would like to start off our course about the foundation of finance and economy for business. We see throughout this course, we see how the business related to the finance and economy, since they are not separate discipline. So we see a lot of techniques and theories about the business and the investment. So to dive deep into the world of economy and finance, this video course will give you great foundation. If you are going to make the smart decision, or if you are going to make to grasp the economic downturn, this course will get you a lot of important method to tackle or to manage your business. This course combines theory with practical insights, as well as there are a lot of techniques like we shall see the time value of money, and also the cash flow and many other techniques throughout the session. As you experience it, you see a lot of people, they start business, and then when they reach a specific level, the business started to decline, or to make a business to make to fall down, because of those people, they are lacking the techniques to manage or to proceed the business. So, and I hope this course will give you a lot of essential techniques you might need when you are going, if you are a businessman right now, or if you are going to start a new investment. So this video course, we shall cover a lot of techniques and theory about how your business become more successful. Welcome our course, economy and finance related to the business. So our course will cover the following topics. We shall see the key concept, like the time value of money, capital markets and evaluation, what is the capital markets and how to evaluate, business strategies and financial statement, analysis of financial statement, capital budgeting, cash flow and business cycle, ESG, environmental, social and corporate governance, macroeconomic and fiscal policy and monetary policy, portfolio diversification and management, alternative investment. Okay, we started this experiment. You see this pockets. If this pockets gives daily or output of this pockets is $1 per day, or $5 or $10, $20, and run forever, how much will you pay for these pockets? A lot of money people are saying we are paying for 10,000. Some people say we are paying for the $100,000, or others say 1 million. So people have a different views how to benefit this investment, because the return is fixed, and this focus is much focus will give you this return. So people have different, they look a different angle how the money they invested this focus. Okay, instead of the buckets, let's change the buckets into saving account. If you have a saving account and they promise you that if you deposit your account some amount of money, you will get 1% of interest rate. So, how much will you invest in this, and how much will you put this in your account? If you are interested to receive the 1% of interest rate, or 1% of return, anything or any value you deposit in your account, you will get 1% of interest rate. So how many will you put your account? So let's see a statistical summary. These are the statistical summary of the investment, or how you invested, how money you put your account. As you see, the interest is 1%, and so what amount generate $1 one interest rate, one of interest per day? This means what amount you will put to your account. You are going to get a receipt to earn $1, 1% of interest rate. The amount you will put, you will use to put this account will be $34,722. As well as another example, let's see this example. If you are going to buy home, say when the purchase price of the home is 1,000, but you pay in advance 20,000. So the remaining is 8,000 is a mortgage loan, which is secured by loan by home, and this has interest rate because you are paying the yearly interest rate. If you take take this loan, you will pay some amount of the interest rate through the end of the principal. So let's see the statistical summary as well as the time of the you are paying this loan is 20 years, says 20 years, and the loan is the amount of the loan is 80,000 USD. So how much would you pay each year? You are paying each year 9,396.77 each year. This means the total when you are the interest the loan will end up and after 20 years 267,935.77 USD dollar. You see the how the interest is first you lend 80,000, then lastly the loan will end up 267,000, which is more than 3 times or nearly 2 times more than the money, the principal you have lent. This shows us that the cost of interest, how the cost of interest rate impact your loan, because you see here the cost of interest rate you are paying each year is 9,367.7. So, but the principal is only decreasing 1,600. Others are going to you are paying the interest rate. Only principal you are paying, only business is reducing 1,600. If you make calculation, you see it. So this because of the interest rate, the cost of interest rate is much higher and is not is changing the year of the year. And mostly they are until you end the interest rate, the principal is reducing much less than the interest rate you are paying. This is another example. So we see this key concept of investment, return of investment. We see what is the ROI, how it's good for the investment, as well as we see another techniques of investment, time value of money, net present value. Okay, let's start the return of investment. Okay, these are the question. Will you rather make a return of 1,000 or 25% in investment? If you make investment, will you prefer this investment will give you 1,000 or 25% of return? So what are how ROIs or will guide you? ROIs allows you to compare the efficiency of one investment that of another. ROI will guide you to choose different investment between different investment. You prefer one investment from the another because if the high return if one investment is high return, you will choose that investment than the other. Also, ROI measures the amount of return on investment related to the amount invested. This means you invested some amount of money, then the return. What will be the return? ROI measures this investment, this return. and you see what's your return of what is your return what is your investment return. You see, I will give you the ROI. That is very important techniques. So the formula which we use, return on investment, or ROI, current value of investment, cost of investment, divided by cost of investment, which means now the investment you invested previous year, say 2 years before, you invested a machine, to buy a machine, 2000, say 2000, then or you buy home in 100,000 USD. Then the current price of the home now is 120,000. So you get a benefit from the investment, because the current investment is different from the previous investment. Okay, why ROI is important? Make comparison of investment in different security or assets. ROI makes you to make comparison various investment or asset classes, and it expresses for us as percentage for you. 25%, you benefit, your profit will be 25%, or 35, or 40, so whatever. But the ROI makes this comparison for you, as well as another point, to provide basic measures of investment probability. It also gives you the measurement of the probability of investment, whether your investment is making return or not, or what's the return of your investment. It's basic element of investment analysis and decision for companies individual. This technique is useful for the various people, individual. If you are alone making investment, you use the ROI, or the companies, as well as the companies are making the investment. They are using these techniques, which is important. Is one of the importance of ROI. Return on investment, some limitations. There are some limitations. There are some challenges, or something which you are preferring to take to invest one investment to another. For example, these two investments, as you see from here, this example, which is better investment? Say we invested 1,000 in some real estate and sold it for 1,000, and sold it for 1,200 or 1,200. So if we apply our formula, and the first investment will give you 20, and it's 1 year. It's 1 year, 20 return, 20% of return. Okay, when it comes to the second investment, we bought a stock or share, 2,000, and we sold it 2,800 3 years later. You see, the other investment is the return is 40%. So which one will you choose these two investments? According to the time, we use the first investment because it's short time. We only receive 1 year 20% what we invest. According to the return, the second investment is higher than the first investment. So we choose which one will we choose? We choose if we want to take the short time and short and small return. We take the first investment. If we are looking for the long or for a long time, we use an high investment, we use second investment. This depends on your decision of investment. Okay, let's come the time value of money. And yes, we are using continuous compounding. And so if we invested a saving account, say we earn 10% of interest rate 20 years. For example, if we invest in $1 today, then we receive that after ending of the time of our investment, we will end up 6.7 times our investment, which means now we invested $1. 20 years later, we will receive $6.73 from the our return of investment. In spite it's for a long time, but it means 6 times more on what we have invested. We get 6 times more what we have invested. So, time value of money are the key concept. If we look at the concept of time value of money, which says money is worth more today than in the future. Which so if you have money today and you are not invested in anything, because we are prefer because the reason we are prefer money today, the value of the money today is higher because of we can invest this money today and we get and will generate some revenue. That's why we prefer money of today to get $1 today than rather than to get 5 years $1, because $1 today we can invest, it can generate revenue, and but 5 years later, if we get a $1, that means there's a risk related to that money. Like this risk comes from the macroeconomic variables or macroeconomic policies. You see, money is more value today because potential earning, as well as if we because and also as well as the riskiness of the future cash flow and impact on inflation. That means if we take receive $1 today, we have more. We prefer more than the future to get $1, because the future is uncertain. There's a lot of things which the money can lose the value, because there's interest rate might change and the value of the money might change. That's why we prefer $1 today. So will you prefer $1 today or 1 year? We prefer $1 today because those resources. So when it comes to the next techniques, net present value, which means net present value, it means that the net cash flow and net cash outflow. Okay, net cash flow and net cash inflow. Net present value, before we calculate a net present value, first net present value is straightforward, is a pretty straight forward concept. As you see from the name, it's net income, which determines net cash flow, which determines the value of the asset. Cash inflow and cash outflow essentially represents the income versus the income and sunk costs. The cash we receive contains two things, because when there's a cash outflow, which is the cost we initially invest, and the revenue which we receive our activities of investment or our return of investment. So before we calculate net present value, if net present value is greater than 0, that means that investment is generating income and it's a positive investment. So before we go to calculate the net present value, we have to understand the discount rate. What's discount rate? Discount rate is not something else, it's interest rate. And discount rate is used to determine the present value of future cash flow. Okay, in discount analysis, when we are doing discount analysis, for example, you see here discount cash flow. You see, for example, here you see we invested 10,000. We buy say we invested a machine, say first year we buy 10,000, we invested 10,000 the machine. First year we earn 2,000. Second year we earn 3,000. Third year we earn 5,000, and the last year, fourth year is 7,000. When we add together, the total cash inflow, the total of cash inflow are 17,000, which is greater than the money we invested, which was the 10,000 USD. So when we subtracted 10,000 from the 17,000, the net present will be 7,000. Net cash flow will be 7,000. So we look at this 7,000, net 7,000, we will receive 4 years later, and there will be something which impacts that cash flow, which is inflation, so or interest rate. So the money the money we receive 4 years later, there is something which causes the money to lose the value. This thing is which causes the money to lose value is called the discount rate. So when we are calculating net present value, we assume discount rate 5%, say 5%. Now we have 7,000 net cash flow. Then we assume discount rate is 5%. So our net present value will be 4,704 USD, because first we get 40,000, 40 year we get 7,000, but the discount rate or the interest rate causes the money to lose the value. That's why we are first we have to understand before we calculate the net present, we have to understand the discount rate, and I think you get it. So last comes the financial understanding of financial markets. What is financial? First, this question: what is financial markets? What are the capital financial markets? Financial markets are the place where two or more people exchange goods and services. Financial market is the market. You know the market is the marketplace. Okay. What are the capital and financial markets? What is the capital finance? What is capital finance and who provides? What the capital? Who paid this capital? We invested the business. Who paid? And what is this capital? How do business and government obtain financial capital markets? How the government and business receive financial capital? Receive the investment from the markets. Okay. How government and the business get finance or the investment from the markets. Okay, financial markets, there are two. The one we will know, physical markets, and the other is virtual markets. Physical markets are traditional markets, like our supermarkets, grocery, so and many other markets you may know. You see your country or your town. These are the markets, the one you daily buy something, food or the meat or something else. These are the physical markets. And virtual markets are different markets. They are basic commercial, and as you see from the you see the Amazon. Say Amazon. These are the Amazon is a virtual market. You can make business with Amazon. You can make exchange goods and service the Amazon. You make a subscription. You subscribe their page, and then you order what you need. That's the virtual markets. And it's different today. Most of the world they are moving towards the virtual markets, because the world now is becoming like the small village. The internet will simplify the business. You hear the P2P business to business and many other types of the business. Today, most of the world they prefer the virtual markets, and they are relocate the previous traditional markets, but still exist in developing world. But the most of the developing world, they now the dominant the market. The people are the exchange takes place in the virtual markets like Amazon, Netflix, and many other virtual markets. So, effect of financial markets. What is the importance of financial markets? Financial markets are vital to grow the farms as well as as well as the individual to achieve their stability. Many farms produce goods and services that individual will not be acquired themselves. So the importance of financial markets, which means if the farms they produce goods and services, if there is no markets, where do they meet the how do they meet the customers? So the markets gives this they make they simplify how they meet these two parties, customer and the farms who produce the goods and services. They meet the markets. So that's one importance of the financial markets. Secondly, importance of the financial markets are that unless there is no financial markets, farmers will not get return from what they produce. It's another important thing which my financial markets may have. If there is no markets, the farmers they will not sell anything because they will not get and they are not the farmers they are not making growing because the business the growing of the business is based on the return they receive the return or the profit. So unless the markets there is no return, that means the farmers they will not exist as well as the so financial markets is important the farmers to exist as is very important and it's very important for the consumers because the consumers they will not get where they to buy something or what they need. So that's the importance of financial markets. Okay guys, today our lesson and I end up my session here. So thank you if you watch. So and I first if you watch the video, please thumb up and subscribe, like and share the channel. Thank you. Till next time. Goodbye. Wassalamu alaikum wa rahmatullahi wa barakatuh.